This video is brought to you in partnership with Stake. If you're in Australia, you can take advantage of an enticing offer. Transfer at least $1,000 worth of Aussie shares to the Stake platform and enjoy 12 months of free brokerage, subject to Stake's rewards terms and conditions. In recent weeks, Tesla's stock has experienced a notable rise of approximately 20%. However, despite this rebound, the stock price remains a significant 45% lower than its peak in December last year. This drastic decline has led investors to nearly halve the company's value, which currently hovers around an impressive $850 billion. Elon Musk, once celebrated as a visionary leader, appears to be losing favor in the media, primarily due to his increasing involvement in political matters and his controversial public demeanor, which has alienated a segment of the investor community. His alignment with the U.S. president, support for Germany's far-right political factions, and an array of unfortunate gestures, often misconstrued but interpreted as Nazi salutes, have collectively sparked a wave of public discontent. This backlash has manifested in alarming and extreme forms of protest. Reports indicate that individuals have been vandalizing Tesla property, engaging in acts such as setting fire to supercharger stations, defacing Cybertrucks with swastikas, and even stealing wheels from parked Teslas. One particularly disturbing incident involved gunfire directed at a Tesla showroom in Oregon, highlighting the growing animosity. As public sentiment sharply shifts against both Musk and Tesla, investor confidence has similarly faltered. This represents one of the most dramatic sentiment reversals I've witnessed during my time observing market trends. Following the U.S. elections on November 5th, the stock market reacted positively to Donald Trump's victory, igniting a surge in Tesla's stock price that soared approximately 90%. Elon Musk was celebrating. The stock valuation skyrocketed, and his personal wealth reached an astonishing $486 billion. An amount comparable to the valuation of a company capable of producing 500 planes, valued at $100 million each year. However, this gain has evaporated just as swiftly. The decline in Tesla's share price became so pronounced that on March 20th, Musk organized a surprise all-hands meeting, live-streamed to Tesla's YouTube audience, in a bid to inject some positivity into the narrative and stabilize the fluctuating stock price. Haish and I delved into the implications of this meeting on a recent episode of the Young Investor podcast. The session essentially served as a one-hour exposition on Musk's optimistic vision for Tesla's future. He asserted that Tesla would emerge as the most valuable company in the world by far, and urged employees to hold on to their shares rather than panic. Some prominent investors, such as Cathie Wood from ARK Invest, still maintain their belief in this optimistic outlook. What Musk was implicitly conveying was a message of reassurance to stakeholders. Hold on to your stock. Interestingly, the live stream appeared to have a positive impact, with Tesla's stock price climbing roughly 12% following the meeting, underscoring the volatility that currently characterizes the market. A particularly intriguing aspect of the live stream was Musk's reference to Warren Buffett's Mr. Market analogy to articulate the current fluctuations in stock value. He compared the stock market to a whimsical individual shouting prices at your home every day, sometimes based on rational assessments, sometimes not. The crux of the analogy is that regardless of market sentiment, the intrinsic value of the business, or the house, remains unchanged. This brings us to a fundamental question. What is the actual worth of Tesla stock? To answer this pivotal question, we must explore how investors ascertain business value, commonly employing a method known as discounted cash flow (DCF) analysis. Without delving into overly technical details, which we explore in depth in our Introduction to Stock Analysis course, link provided in the description, here's a simplified overview. Imagine you were acquiring the entire company outright. As the owner, you would retain all the free cash flow generated on an annual basis. You would project this cash flow over the next 10 years, estimate a final salvage value at the conclusion of that term, and then discount all those future cash flows back to the present day utilizing your preferred rate of return, let's say 15%. Summing up all these present values yields the intrinsic value of the business today, providing critical insights for investors navigating the tumultuous landscape of the stock market. Here's the catch. Predicting each year's free cash flow isn't straightforward. It involves making informed estimations based on extensive research into the company's financial history, current market conditions, and future strategic initiatives. The growth rate applied to these projected cash flows dramatically influences the resulting valuation, making it a critical factor in any analysis. This inherent uncertainty is what makes Tesla such a polarizing subject among investors. Some analysts forecast phenomenal growth potential and assign ambitious growth rates, while others view the lofty promises surrounding full self-driving technology as overly optimistic, considering Tesla merely as another traditional automaker with limited growth opportunities. Personally, while predicting outcomes over the next 6 to 12 months poses challenges, I believe the 3 to 5 year outlook for Tesla remains exceptionally optimistic, assuming, of course, that everything aligns favorably. Historically, Tesla has faced accusations of being overvalued by a significant portion of the financial community. It's often described as a cult stock, where the relationship between its stock price and the underlying fundamentals of the company appears tenuous. Elon Musk frequently asserts that Tesla will play a pivotal role in shaping the future of transportation. Yet critics, particularly on platforms like CNBC, deem its valuation excessively inflated. This discordance largely arises from the differing growth assumptions employed in valuation models. One effective way to scrutinize these growth assumptions is through reverse engineering the valuation equation. Over the past 12 months, Tesla has reported $97.6 billion in revenue, yet it generated only $3.58 billion in free cash flow. For Tesla to be considered fairly valued at its current market capitalization, we could estimate that if the company were to be sold in 10 years, at a valuation multiple of 20 times its free cash flow, it would need to achieve a staggering annual free cash flow growth rate of 43% to 44%. At its previous peak, share price of $480, which assigned a market cap of $1.42 trillion to the company, this growth requirement escalated to an astonishing 52% every year for an entire decade. The critical question arises: is such sustained growth even feasible? To provide some context, Tesla exhibited remarkable revenue growth between 2018 and 2023, achieving a compound annual growth rate, CAGR, of 47%. While extraordinary growth has certainly been achieved historically, it's essential to recognize that free cash flow dynamics are far more intricate than revenue figures alone. Free cash flow encompasses all operational and expansion expenses, including costs related to factories, research and development, equipment, and more. Unlike many software companies, which typically experience lower capital expenditures, Tesla's capital-intensive nature makes achieving sustained growth in free cash flow that much more challenging. This is particularly true unless Tesla enhances operational efficiency significantly or identifies new revenue streams with higher profit margins. This brings us to Tesla's potential game-changer, full self-driving FSD technology. If successful, this could transform Tesla from a hardware manufacturer into a formidable software-centric enterprise. The paradigm shift of converting Teslas into robotaxis could be immensely profitable, positioning the company to capitalize on near-zero marginal costs characteristic of software, facilitating scalability. Currently, Tesla charges $8,000 upfront for FSD or offers a subscription option at $99 per month in the US. If FSD achieves full autonomy, its value could surpass that of the vehicles themselves. Consider the implications for drivers within the gig economy. such as Uber drivers or delivery service operators, who would no longer need to compensate human drivers, making FSD an invaluable asset. Proponents of Tesla argue that this innovation could open an entirely new market segment with exceptionally high margins. This optimism is why investment firms like ARK Invest have set audacious price targets. One projection estimates a staggering $2,600 by 2029. Cathie Wood, the CEO of ARK, predicts that robotaxi revenues may account for an astonishing 90% of Tesla's earnings by that time. Conversely, without the realization of this new business avenue, their price target could plummet to just $350. Interestingly, this scenario mirrors the trajectory of Nvidia. Initially recognized for its gaming GPUs, Nvidia transitioned to AI chip sales around 2020 to 2021. At that time, its elevated price-to-earnings (PE) ratio seemed excessively high. However, with AI-driven earnings surging, those previously deemed overvalued price points now appear quite reasonable. Tesla could potentially follow a similar path, evolving and capitalizing on transformative technological advancements. The pivotal question that continues to perplex investors and analysts alike is, what is Tesla truly worth? With its stock having tumbled nearly 40% recently, many are left wondering whether this is an opportune moment to buy into the company, or if it remains overvalued. As a Tesla shareholder myself, I admit that even I grapple with the challenge of accurately valuing the company. The crux of the issue lies in our growth assumptions. For instance, if we project a modest annual growth rate of 10%, Tesla's market capitalization could plummet to around $100 billion, representing an astonishing 88% decline from its current valuation. Conversely, if we factor in the potential of a comprehensive full self-driving FSD business, one that could generate upwards of $200 billion annually, the previous valuation might actually start to appear reasonable. Considering Tesla merely as an auto manufacturer likely suggests it is overpriced. However, there exists a compelling case for viewing it as more than that, envisioning it as an AI, robotics, and energy powerhouse. I don't wish to come across as an overzealous enthusiast, but this future potential is tangible and substantive. If you are contemplating an investment in Tesla, it's crucial to approach it as a long-term endeavor. One must also temper expectations for quick gains. Tesla is not a stock suited for the high-frequency trading mentality of hedge funds that focus on quarterly performance metrics. The timelines associated with breakthroughs such as fully autonomous driving capabilities or the anticipated Optimus robot implementation remain largely unpredictable. These milestones will materialize when the technology is ready. As long-term investors, we don't require exact timelines. What matters is believing in the eventual success of these innovations. However, this perspective does bring inherent risk. Should Tesla fail to deliver on its promises of autonomy, the share price may very well decline even further. Elon Musk himself has been clear on this front, stating that the value of Tesla overwhelmingly is autonomy. Everything else is noise. Therefore, for those who harbor doubts about Tesla's ability to achieve its autonomy goals, it might be prudent to divest from the stock. Conversely, if you maintain confidence in Tesla's trajectory, it may be wise to hold your position. I'd love to hear your thoughts on Tesla stock in the comments below. Additionally, if you're interested in gaining a deeper understanding of stock valuation techniques, including a comprehensive breakdown of discounted cash flow analysis and insights from Warren Buffett's investment strategies, I encourage you to check out our Introduction to Stock Analysis course at Wealth Wisdom Education. This professionally produced course spans 7 hours and is designed to equip you with essential knowledge. We'd be thrilled to have you join us. If you found value in this discussion, please consider leaving a like, and I look forward to seeing you in the next video.